welcome into the program. This is your game plan for retirement with Northwestern Ohio's resource for that common sense approach to planning for your financial investment and retirement future. He is president and founder of McIntire Retirement Services, Chris McIntire, with us once again. And Chris, one of the best parts of this program is to get a better handle, a better understanding and education on the different choices and options that we have to utilize our money to grow and to help us formulate the plan to achieve our goals. And that is always a goal there at McIntire Retirement Services for your clients to really have a better understanding and be more comfortable with their money.
Yeah, for it surely is. And, there is no lack of investment options or places to put your money for sure. And I suppose if you don't do this for a living and you're the average American investor, been putting money blindly into a 401k and, the 3 or 4 or 6 different choices that, are provided by those employer sponsored plans, many of the folks have no idea how many options there truly are. They're used to a retirement lifestyle 2020 fund, for example, or a 2025 fund. And, there is a lot more to it than just that. And especially in retirement, because sometimes you're looking at income generation versus growth.
Yeah, sometimes a whole different set of tools becomes available or useful for your purposes as we transition into different phases. And certainly the 401k, you touched on that one already. That is a tool that is widely available to most Americans. That is certainly something that we need to understand. And we'll dive into the different aspects of the tools that we have available to us, ladies and gentlemen, and when and where and why they are beneficial or what you would need to know before getting into them. The pros, the cons, the goods, the bads, the ugly of the different investment options is going to be the theme of today's program, discussing a variety of different choices that you have. And there are many different ones. So we will dive in at a surface level, try to give some details, a synopsis for you. But if you want more details, and more importantly, if you would like to structure the plan for your financial future, looking at income, investments, taxes, healthcare, legacy, and then through that process, narrowing down what investment options are most appropriate for you. That is the process that is available to you. The ability to have that plan, to structure it, to construct it and put it together, along with the help of an experienced, qualified professional in Chris McIntire there at McIntire Retirement Services and the team behind him at McIntire Retirement Services. If you'd like to take advantage, pick up the phone, give a call, 800-868-1194. That is 800-868-1194. 800-868-1194. Chris, let's start at the beginning, if you would. When we earn our first few dollars, most people end up at one kind of institution in particular with their money to kind of start their financial progress and probably utilize that financial institution or that type of institution throughout the course of their lifetimes out of necessity. And I'm speaking of banks. We start earning money. We have a little bit that we have accumulated and we go to the bank. Well, the bank is a very useful location for money, but there are some things that we need to understand about banks and bank accounts in order to know how much to utilize that bank.
Yeah, Peter, it's a great place to start. Nice and simple, kind of the ground floor, if you will. And, I think, we all have a function of, what banks can do. The traditional side was, hey, we borrowed money from a bank to buy a house. We put money in a savings and a checking account. And, now they offer CDs and, a plethora of other options that are available for, for many of the citizens of this great country. So we can talk about, checking, savings, money market accounts are very popular right now because as interest rates went up, you make more money in a money market account, which is technically a version of a mutual fund, right? It typically has a symbol, and for us right now, we use a Fidelity money market account or a Charles Schwab money market account. And in the United States right now, Peter, it's over $8 trillion is in money market accounts. So
wow,
an astounding amount of money probably came out of the stock market or the bond market and moved into money market accounts. And, as people may have had CDs that were renewing, at the traditional banking institutions. They may have moved that money into a money market account because they don't have to wait a year to take it out. That's the nice thing on money market accounts. It's liquid. There's no timed investment there. And, I think, Peter, down in your neck of the woods as well as up here in Northwest Ohio, I get an email 2 or 3 times a week from a different bank offering a kind of a teaser rate for new money coming in. They don't treat my old money like they would new money.
Right, right. Well, yeah, and you mentioned borrowing. That is another important use of the banks. It's where we can borrow money if we need a loan, if we need to buy a car or a house or the like. But a lot of people also are using it as a storage. And Chris, the main reason why we use banks for storage for our cash is the two qualities that they provide for us are safety. We know the money is going to be there. It's not going to disappear if the market goes down, and liquidity. And we can get our hands on the money when and if we need it. And so there is time and place and reason to utilize banks, but a lot of people may be keeping more than is appropriate in banks because of those qualities, but not realizing that even with these higher interest rates that you mentioned, Chris, banks generally don't keep up with the cost of living and the true cost of inflation. And we may be losing money safely if we overutilize banks.
Sure. And, that was really true there for, let's call it the past decade, at least, where, I mean, the interest rates that they were paying were next to nothing, essentially. It's just in the last 12 to 18 months, if you will, that we started to get a spike in some rates there. So, many folks, it is so convenient that it's parked there and it takes effort to move it into different places. And, different generations do things, some people like to do things electronically. Some people do not like. I have clients that want to get paper checks in the mail. We have clients that say, look, don't bother sending me a check. I want to make an electronic transaction because a paper check is still an electronic transaction. That's how money still moves anyway. So, as we coach folks through some of those processes there, we can help them, look and utilize, like, for example, we use Charles Schwab. I can buy CDs across the United States on Charles Schwab. And, if the client wants to sell it and get out of it, we just put it out there and sell it. They don't have to pay a penalty to get out of it. It's typically very marketable. So brokered CDs sometimes pay more interest because, I can shop around the United States for them. So a lot of different ways to accomplish this. And I'll be on, and for full disclosure, look, I need to have some money up at the local bank uptown in case an emergency came and I needed $10,000 in cash. I need, and I need it today. That's why we keep our emergency funds very close at, local credit unions, local banks, no question about it. Not to discount anything here, buddy. We're talking the good and the bad and the ugly of all of this, not taking one side.
Yeah, but Chris, we talked previously about the tool that allows you to see how much is in deposit, FDIC insured account. The FDIC has kind of a tool that tracks how much money is in banks, and just in the local zip codes here across northwestern Ohio. Really, Perrysburg and surrounding areas, $1.255 trillion in deposits as of June of 2023. So a lot of money being kept in banks. And Chris, that's a lot of money that maybe could be doing a little bit more for the owners of those dollars.
Yeah, sure could. And, and when we park it in a CD, so if we've got an extra $100,000 to use a round number and we throw it in a CD generating 5%, that's $5,000 of interest that's taxable. So for a lot of folks this year who have CDs that have renewed or money markets that have paid interest, they're getting their 1099s and like, well, God, what is this 1099 for? We're getting these phone calls because we have, we buy CDs for clients as well, too. They're just not used to making any interest. So it's some, a little shock to the system there for many folks these days, too, buddy.
Yeah, indeed. Well, a bank is a relatively simple place to keep your money. We generally understand that, although we also need to understand that banks assessed more than $6.4 billion in ATM fees and overdraft transaction fees as of 2022 is the statistics I'm looking at. So they're not there as nonprofits, ladies and gentlemen. You got to understand that they are making money off of your money. But Chris, when we want to make a little bit more money, we move on to generally investing, or at least other options for the placement of our money, of which there are many. Give us maybe the next one on your spectrum of available options that you find people need to understand in order to truly evaluate whether or not they want to use this option.
Sure. Yeah. Let's start talk about bonds, for example. And a bond is somewhat similar in one respect to a certificate of deposit. You're loaning your money to the bank. They're paying you interest. A bond, you're loaning your money to either a government, U.S. government, state of Ohio, or you're, or a corporation, a corporate bond for a specific period of time. And there are many of these out there that you can choose from. So in a sense, you're giving them money and they're going to be paying you interest for it. And at some point in the future, you get your money back. And then the idea would be when the bond matures, ideally, you can reinvest it at a higher interest rate to keep up with it, keep the pace with inflation. So, that's, as interest rates have risen, that's what's nice on older bonds that are maturing now. They can be reinvested at a higher interest rate. So, if you've got a bond that is, for 10 years, for example, and just say a 10-year U.S. government bond, it is backed by the full faith and credit of the United States government. And, obviously we're $34 trillion in debt, but we haven't defaulted on any of those loans. So, typically considered a very safe investment. I had to throw that in there because I know people listening, that's what they're saying. I get it. And
There's some concern about stability out there,
sure.
right? Of the dollar itself. That is actually a place to store our value, is in dollars. That we have to put faith and trust in that being a system that will stand the test of time.
Yeah, no question about it. And the bond market is like 3 times the size of the stock market because you think of all the companies and states and governments that issue bonds, a lot more of them than publicly traded companies makes a lot of sense to me. But there are risks with bonds. One of them is default. So does the corporation or the government not be able to pay the money back and files a bankruptcy or something like that, for example? Good example of that would have been mortgage-backed bonds in the 2008 financial crisis. Okay, a lot of bond failures there, or some of the banks that failed, their stocks got wiped out. In a lot of cases, their bonds got wiped out as well. Okay, there is interest rate risk, which what we suffered in 2021, 2022, when interest rates go up, the value of bonds go down that are already in force. Okay,
And Chris, that was actually an anomaly. It doesn't happen often that bonds or the bond market on whole kind of lose such significant value. But 2022 was one of the worst years on records for bonds, and bonds are traditionally considered the safer or more conservative side of the investment spectrum. And that's why a lot of people go to bonds, correct?
Yeah, that is correct. So if you were opening your investment statements as they raised interest rates like 11 times in a row, you're looking at your conservative investments like, man, I'm getting hammered over here, and that's just the anomaly of rising interest rates pushes bond prices down. And then if you go from about November 1st of last year, when the Federal Reserve says, look, it looks like we're done raising rates, those bond prices really came back because bonds have a value every day, just like a stock does. So if you buy a bond and you plan to hold it for 10 years, do you care what the value is every 30 days on your investment statement? No, because you're going to keep it until it matures where you get your money back. Okay? But most investors that have a bond mutual fund, are looking at the value of what was in that bond fund. It had 50,000, 3 months later, it's got 45, it lost 10% of its value. But all those bonds inside that mutual fund continue to pay interest. as they mature, they reinvest in bonds that pay a higher interest rate. So you're investing in future higher rates of return. You just have to have a mindset of more than 30 days when you look at the value of your investment statement, and not many people do.
Okay, well, we are trying to get a better understanding of the different investment options that you have available to you, ladies and gentlemen, the different placement of your money. And you need to have this understanding in order to evaluate what is the most appropriate option to achieve your financial goals, which is going to help be determined by having a plan in place. And that's what Chris McIntire strives to help you achieve and accomplish each and every day there at McIntire Retirement Services. Not only having that plan, identifying risks, issues, and opportunities, but also a better understanding, a true education of how you are deploying and utilizing your dollars, what investment options are available to you. And if you'd like to get that game plan for retirement put together, pick up the phone, give a call, 800-868-1194. That's 800-868-1194, 800-868-1194. And Chris, just due to the limitation of time and the number of different options, let's try to move through them here. We talk about stocks, bonds, and mutual funds all the time. We've covered bonds, so let's talk about the stock market now. Stocks and mutual funds are very common investment options that we utilize.
Yeah, without a doubt, buddy. And we use stocks for a number of different purposes. Okay, we can use stocks for growth, and we can also use stocks for dividends, or a combination of growth and income. Okay. So if I'm investing in a company like a utility company, right, that's not a growth stock. That's more of an income stock where they're paying out dividends, and dividends are just profits. Okay. General Mills is a good example of an income stock. They make lots of cereal and they pay good dividends. So that a reason a retiree would want to own companies like that is, regardless of the value of the stock, we're getting the reliability of a steady stream of income off of the dividends. Okay. And then, of course, here, we can talk about the tech stocks. NVIDIA, for example, that is skyrocketed. That's a growth stock. Amazon, Apple, heck, even Facebook recently came out and said they're going to start paying a dividend. So, and we saw their price spiked here at the beginning of 2024 significantly, on that announcement alone, because now it makes it more attractive to put that stock in different types of investments. Different mutual funds are going to use Meta. I'm going to call it Facebook. I think most of us are still familiar with that. But it is a great tool to grow wealth, to keep up with inflation, and stocks can also be a great tool to use as income.
Chris, kind of the important distinction here, when you buy a stock, you are the owner, a part owner of that individual company. You hope the value rises, the share price, the value of the company goes up. But as the owner, for certain companies, you're also entitled to some of the profits each year. That's the form of dividends. As I understand it, when you buy a mutual fund, you are diversified across many, many, many different companies, but you are not technically the owner the same way you are with a single share of stock. Rather, you are participating in the mutual fund, which has that ownership share. So it may or may not kick out the same kind of dividends. Is that correct?
That is correct. Yeah, you can kind of cherry pick and buy some individual stocks or individual mutual funds that are really focused on companies that pay dividends for yourself. Or you could buy a mutual fund, individual stocks that are focused on growth. So that's why a lot of times you'll see that in your 401k selection, the Growth Fund of America, for example, or the Income Fund of America, for example, kind of a popular company. That's how they have named theirs. Good marketing. But, and then to take that another step further, Peter, for the general audience out here, the people who may have 10, 15 years more to work in their retirement, they may say, well, why don't I just invest in the stock market itself, the index, the S&P 500, because there you get a broad-based, diversified portfolio matched with the S&P 500. So you get a lot of the big companies in there. And you can do that with a much smaller investment than trying to buy all the individual stocks. So, very tax efficient to utilize that type of mutual fund and index fund. And then there are many different indexes, right? We have the S&P 500, we have the NASDAQ, we have the Dow, the Russell 2000. So big companies, medium-sized companies, small companies, lots of different ways to, kind of slice and dice that index pie, if you like.
And there's an important distinction there between index funds and mutual funds, Chris. As I understand, they sort of have a similar goal in that diversification, but mutual funds in particular may have some inefficient qualities if we are investing non-retirement money, as I understand it, right? We can just invest money whenever we want. We don't have to be limited to 401ks or IRAs. We can invest in brokerage accounts, but mutual funds compared to those index funds or ETFs may have some distinct differences, as I understand it.
Correct. Yeah. The ETF is the exchange traded fund, which is like a cousin to a mutual fund. Mutual funds have morphed over time, and exchange traded funds, very closely related. And they're just traditionally lower cost and very tax efficient vehicles. So, like the Growth Fund of America I was utilizing there, you have a manager of that fund who's buying and selling on behalf of the investors in that mutual fund. So if you own that fund outside of an IRA account, when that manager buys and sells stocks, a lot of times at the end of the year, right, or they're doing a rebalance, if you will, they may spin off some capital gains, and you get a big 1099 for money you didn't spend. So we call that passive income. Exchange traded funds can help eliminate that piece of taxation, and let you control when you pay your taxes. So myself personally, we have more money outside of an IRA account than we do inside of an IRA account, because I like capital gains taxes versus income taxes. That's just my take on it. I don't like any taxes, I should say.
Well, we're going to get to that in just a moment. The tax qualification, the tax status of our money, wherever we put it, whatever investment option we utilize, is always a very important consideration. But I did want to touch on an additional investment option, Chris, that we hear a lot about. They are widely discussed and debated, but annuities. And we do need to have a good understanding of annuities, specifically if we are considering putting our money in one.
Sure. Yep. And lots of different uses out there, right? Most people probably, if you don't know this space very well, think of an annuity as like, look, I'm going to get a pension. I'm going to get some income out of it, right? And there are certainly, Social Security or your pension is a form of an annuity. You're going to get a monthly payment for a specific period of time or as long as you're alive. Okay. The more common type that we're using for clients right now would be tax deferred annuities. So somebody retires, or they get the option to take a lump sum of their pension money, and they may say, look, the problem with my pension is if me and my wife pass away, none of that money pays out to our beneficiaries. So we're going to take that pension rollover into our own annuity. We can determine when we want to take the income out of it. And if, God forbid, we get killed in a car wreck 3 years into it, whatever's left gets paid out to your beneficiary. So, that's one example. Hey, how do you grow money inside of an annuity? That's a tongue twister. There's different types of them. There is the traditional fixed annuity, which kind of ties in a little more closely related to a CD, for example, paying a fixed guaranteed rate for a number of years. You may have heard the term multi-year guarantee annuity, or a MIGA. So we use 2-year, 3-year, 4-year, 5-year MIGAs that just pay a guaranteed interest rate. I know what I'm going to get, and I know how long I'm going to get it. Okay. At the end of that 3 or 4 or 5-year time frame, you can determine what you want to do with the money. Are they still offering you a competitive rate, or do you want to take it and shop it somewhere else?
And at their core, Chris, annuities are a promise of payment back to you, right? And in fact, even so much as it is on the back of our bills, annuit conceptus is on the back of the $1 bill. It's basically a promise of payment, a payment that is promised to be rendered upon certain intervals with annuities, or at a certain time into the future. But you make a deposit and they promise certain repayment terms to you, correct?
That is correct. Yep. And, as somebody who took Latin in high school, Peter, I'm very proud of you for saying that. Yep. A lot of our, the word annuity is a Latin, right? Yep. Annual, and, so as we tie into what type of an annuity makes sense for the specific client we're dealing with, do they need income, or are they just looking for a safe place to put money for 2, 3, 4-year, 5-year period? Is it money they plan on leaving to their children, grandchildren, or something like that, or spousal protection, of course, too, And so a lot of times we do that here in the state of Ohio. We might have a husband who worked under Social Security, and then a spouse that was a teacher and didn't contribute to Social Security. So, they may lose a Social Security benefit when one of them passes away from the government pension offset, the windfall elimination provision. I'm not going to delve into all that, but a lot of times we can strategize and put an annuity in place in case one of them passes away and they lose that Social Security benefit. So we can hedge that, and God forbid everything go okay and they live a long time, they can turn that annuity on for income and help battle inflation, right? I mean, we've cited, Peter and I go to many conferences. We've had Tom Hegna, Dr. Wade Fowle, PhDs and whatnot. And heck, even was it BlackRock that just came out, who is not an insurance company, and said, look, annuities take a lot of stress off of income portfolios for retirees. People that have annuities literally live longer than those that do not.
Stress factor there.
Yeah.
The reliability of the payments coming in, the income. Yeah, absolutely. I've seen those reports and heard those that have discussed that stat. It's interesting phenomenon there. And again, we are talking with Chris McIntire about your different investment options, ladies and gentlemen. The good, the bad, the ugly of all of them. You need to understand the pros and cons and the qualities, as well as the goals and objectives of the investment options that you utilize to deploy your dollars. And that is through the planning process. And Chris McIntire not only helps construct the plan, but tries to make sure that each and every client has a good understanding to feel confident in what they are invested in. And if you would like to get your game plan for retirement put together, pick up the phone, give a call, 800-868-1194. That's 800-868-1194, 800-868-1194. You can also always go to McIntireRetirementServices.com, McIntireRetirementServices.com. Now, Chris, there are a bunch of additional investment options: real estate, gold, crypto, just to name a few, life insurance. But we have one final important topic that we want to hit on in the confines of the time limits of this program, which is whenever you are making decisions with your money, there are certain options, certain decisions that you make regarding the tax status. And this may be one of the most important considerations with our money.
Yeah, without a doubt, buddy. And I'm double checking my notes here, make sure I would say what I want to say here is, being tax efficient is so very important, because it's where a lot of people let money fall through the cracks. And sometimes those cracks open up pretty large here. And, in the wintertime up here, we kind of call it like the ice, when they have to rescue the ice fishermen, those cracks get pretty wide and a lot of things can fall into them. And so where we like to help people is, converting those IRAs that are forever taxed into Roth IRAs that are never taxed. And what is the most, what makes the most sense? What's the tax efficient way to make that happen? Because I think all of us out here would agree that, look, income tax rates probably have a higher chance of going up in the future than going down in the future. So what better time is it to understand, the ramifications of beginning to move some of that money into the tax-free bucket from the taxable bucket?
Indeed. Indeed. Well, ladies and gentlemen, that is a process that you want to do correctly and efficiently and through a thought out planning process to make sure that you are controlling and minimizing that tax liability without incurring any potential penalties or interest or unnecessary taxation, because it's not what you have, it's what you get to keep, and it's what you do with it that matters. And that is all part of the planning process there at McIntyre Retirement Services. Chris, a high-level overview of some of the more common places that people deploy their dollars, some of the investment options that we may hear a lot about and utilize, and when and where and why they may or may not be appropriate. That's something that you help to educate your clients and proactive savers and investors on during that game plan for retirement planning process. Ladies and gentlemen, again, if you would like to get that plan put together, it is a complimentary service there at McIntyre Retirement Services. No cost, no obligation. Just pick up the phone to get that conversation started. 800-868-1194. That's 800-868-1194. 800-868-1194. 1194 or at McIntireRetirementServices.com. And Chris, I know that you could get much more in depth in any of these options, and you do in conversations with clients. We appreciate the high level overview here on the program.
Hey, my pleasure. Yep, it's a very broad-based topic. We could spend a lot of time on lots of little pieces in here. Hope you enjoyed the show today, folks. Take care now.
Tune into Chris McIntire's full radio program and visit McIntireRetirementServices.com for many additional valuable resources, including other great episodes of Game Plan for Retirement with Chris McIntire. Be sure to subscribe.
The content of this radio show is provided for informational purposes only and is not a solicitation or recommendation of any investment strategy. You are encouraged to seek investment, tax, or legal advice from an independent professional advisor. Any investments and/or investment strategies mentioned involve risk, including the possible loss of principal. Advisory services offered through Brookstone Capital Management, a registered investment advisor.
Fiduciary duty extends solely to investment advisory advice and does not extend to other activities such as insurance or broker-dealer services. Advisory clients are charged a quarterly fee for assets under management, while insurance products pay a commission, which may result in a conflict of interest regarding compensation.